Bismillahirrahmanirrahim. In this lecture, we are going to discuss chapter number 20 from the book Inventory and chapter 21 Bank and Cash. Okay, with the procedure of auditing, an auditor also have to concern, you may say, great concern with the inventory of a entity, because inventory having the value in the financial statements, and these values very important. Because of these values, the financial position of a company may be varied. Another thing, in the point of an auditor, he need to interrogate the inventory system of an entity, either the inventory is available and the other inventory recorded in the financial statements are correct, true, and fair or not. Okay, in introduction, we can see that inventory is one of the more involved audit areas. It's involved in the process of an audit, usually be material for any business that manufacture or sell goods. Inventory is based on the material which is available in the warehouse, and this is used for manufacturers and sell the goods. Inventories directly affect the financial statements, as we discussed the current assets, and as well as reported in the profit and loss statements. In particular area, the auditor check the inventory. Inventory is in my point of view, inventory is probably most difficult area. Inventory in a manufacturing company may be a material. Inventory counts to be subject to the risk. Yes, because it may be the inventory is stolen. It may be it's come past sell by the date. Okay, we can see that over here. In our introduction slide, the auditor have to focus on the quantity of the inventory, the value of the inventory, and the ownership of the inventory. Okay, it's a very simple. The quantity, how much the number of unit is available in the warehouse for the manufacturing or for the selling of the goods, and what will be the value of this available inventory, and either these are correctly and fairly reported in the accounting reports, financial statements, and the available inventory is the ownership of the entity or not. So auditor have the main concern with these 3 points: the quantity, the value, and the ownership. So it can be difficult, like I say, light engineering company. If we take an example of a light engineering company, so inventory over there is a difficult task to calculate in the quantity manner or to evaluate in the value aspect, and the ownership is simple, because it may be there is a steel there is a in the light engineering company there is a different type of steels with different gauges and with different weights. So I think so there is a key concerned person or a specialized person who can evaluate these things very easily, but the auditor need to take a time to evaluate these things. So maybe you say that it's difficult for an auditor to find the right values and the right weights and the right gauges and the right quantity. Another thing have to check in the inventory. The auditor also stated this, either the condition and the value of the inventory. Either he have to check it's illegal to sell it, and the main thing is that the value is lower to the cost or not. So auditor having this kind of reservation or this kind of questions from the inventory point of view. Like in a few businesses, there is a uh, take inventory as a sale or return. Mean to say that inventory sit there. We hope so we sell it. So the physical inventory shows the ownership. The physical inventory available in the warehouse shows the ownership of the inventory, from whom to it's belong. Okay, we can see in next slide there is a stock book, stock count, stock traces, financial statements. In very simple, or you may say that in very short point of definition, auditor may check it from the client stock book, because the client is reported all of the information in his stock book. So auditor is the one evidence is over there, have to check the stock book. Not only on the stock book, the auditor have to count the stock, have to check the inventory. It's basically on the end of the client again, and a client have this uh, duty to count the stock for the entity and for the auditor point of view. Stock traces, maybe auditor have to trace the stock from where he can, from order to, from inventory dispatch invoices to, from inventory invoices, or either from the physical invoices. And these basically inventories having a key role in the financial statement, as we discussed in the profit and loss and the balance account. So there may be a question arise before in the after reading this stock book, stock count, stock traces, financial. This is if a auditor ordered to attend the physical stock. So what he will be do? Obviously, he will go and he have checked the inventory physically. He have to check the stock book of the entity. He have to check the stock. He have to do the traces for the stock, and he have to check the financial statements. Either these assertions are properly and accurately calculatedly mentioned in the financial statement or not. So many business do try to keep book stock, but they rely, our main evidence is the truly stock presentation present in the inventory and its condition. Yes, we knew that most of the companies having the stock books, but the reliable thing is that what present in the inventory and what condition the inventory have. Similarly, like for this, a junior editor is assigned for to visit in the January. There may be a winter and there is a leave over there. There is no worker over there. So this is a very good time for a junior auditor to do his duty to order the attend the stock take. Okay, as it's not auditor duty to count all the stock. Yes, we knew that this is not the duty of an auditor. This is the duty of a client to count all of the inventory record and prepare the financial statement as well accordingly. So auditor duty is to check the stock properly carried out, figures in the financial statement or not. Yes, very simple. This junior auditor who is going for an audit in the January have to check the warehouse and have to check the inventory, have to count. Maybe some of the area, few of the area he can count, but not all the area, not all the inventory. This is the duty of the client to count all of the inventory for the auditor, for the entity as well. And have to prepare the financial statement. Auditor duty is over here to check the company, check the stock company properly carried out, and the figures in the statement are reliable. Check the stock properly carried out, and the figure the financial statements. Inventory is difficult to audit: quantity, description, condition, value, and ownership. Yes, we see the example of light engineering company, as there is a different type of qualities of steel over there, and having different descriptions, like in the, you may say, the according to their measurements, according to their weights, similarly according to their conditions and value and available stock is the ownership. Okay, we have the inventory counts over here. Before this, first thing we need to done it by client the careful planning. Okay, in the inventory counts, before we have to go for the first one thing is we have to do auditor have to do a proper planning in advance, because I'm very care about to check the inventory, so need a proper planning for the stock. As most of the time stock take early in the start of the year, so it has be for the stock rescheduled stuff ideally do by the meeting with the manager and stock staff how exactly the stock to be performed. So at the company end, the company before receiving the inventory, at the start of the year, need to do a plan, or need to do a meeting with the managers and with the staff who are receiving or who are carrying or maintaining the stocks to because of effectively or efficiently performance. Company need to do a complete briefing or instructions to the staff and to the managers. Inventory is properly ordered, and I have to discuss this one as well. Either the inventory is properly ordered, this is called the TD inventory. Okay, second thing is identify damaged inventories. So this is the duty of again the staff and have to check the inventories. Either the inventory is damaged at their end, either the inventory is damaged from the supplier end. So have to view this, have to report properly about the damaged inventories and have to record. Auditor also have to check the damaged inventories, and because but main duty is on the client, and he will the client have to check the damaged inventories of the company, because this is the thing on the basis you may say that the inventory is useful or not. So damaged inventory reports on the damaged inventory report, auditor can say that or can make an opinion or can report this either this inventory is useful or not. Let I say in a room a lot of pre-number. Okay, in the third one, pre-number shelves and the location. Very simple. Let us say we take an example of a room and there is a lot of shelves in the room, and these shelves are properly spaced with the serial number similarly according to the location, left, right, front end, middle. So you have to lot such a sequence, such a number, such a spaces, such a location to the shelf, because you have to place your inventory accordingly, and when you need or when you need to identify and when you need to find out your product or your inventory, so it will be the easy for you, for the client, and easy for the auditor and as well. Auditor can easily check which one inventory is available and which one is the missing. Issue sequentially inventory sheets. Okay, once you have a pre-number or pre-arranged shelves and the location, now you have to issue a inventory sheet. Sequentially mean to say that there is a different column according to the sequence, according to the, you may say that the first one is the having the serial number, the second one is the product name, third one is the quantity, the fourth one is the location, the fifth one is the cost. So there is a sequentially data of the inventory in this sheet. So you prepared, client have to prepare this one sheet for the easiness of their operation as well as for the easiness of the auditor. So auditor may check very easily, and this is the auditor duty to have to check the issue inventory sheet and cross check with the shelves with their locations. Through this, the auditor can easily find, maybe he can say in the shelf 5 in the following space the inventory is missing. And the another thing is need to be see over there, which is a signed off each location as accounted. So it's again very important for inventory count that a person who have to check the inventory by himself properly examine the inventory and have to record it one by one according to the shelf, according to the location, and note it in the inventory sheets. After the end, there is a supervisor, there is a managerial over there who will check this issue inventory sheet again and sign it. Mean to say that there is after double check, the supervisor have to sign on the sheet. Okay, let's continue. Check inventory sheet. Basically, this is the signed inventory sheet is a double check, cross check. Once it is counted by the officer in the officer, and once it's supervised by the another manager. So you have to check account for all inventory sheets. This is the again important thing that we need to see that in the inventory system. Okay, before we have to check, we have to see the inventory for all inventory sheet. There is another check in the inventory check sheet. Auditor need to select the randomly with different shelves and have to check the different stock according to the stock sheet and with the description and trace up to the R. Well, now we have to see that the value of the inventory. In simply, you maybe check supplier invoices to find the cost price of the inventory, and then you have on the stock sheet. You may say that you have to in the first column write the quantity, second cost per unit, third the value of stock, and the end and the bottom you have to sum of all of these. So this is the value you are counting, you are valuing the inventory in the inventory sheet. Reperform calculation. Yeah, reperform calculation is a very easy. But the auditor duty is have to check this. I have to reperform. It may be that the auditor find there are the 10,000 stock added in the inventory in this year, but in the record there is a 100,000 stock added in the inventory, and because 90 there is a gap of 90,000 in stock. It means to say that it can affect these 90,000 inventory on the profit as well. So Arjun need to verify it and need to recalculate and report it to the concern. Inventory valuation. Okay, when we say that the inventory valuation, how we evaluate the inventory, and start we studied the inventory system, then with the inventory valuation. It's accounting policy like a FIFO. It may be auditor reperform the calculation. Go to the inventory. There is maybe a 50 item in the inventory. 70 came from the previous, and 30 comes later to the delivery. Auditor have to see each of the inventory stock according to their time and the available inventory and trace the delivery back with the dates and have to check the invoices and calculate by himself. Calculate the right cost for the inventory. Okay, the second thing is lower of cost and RV, net realizable value. Auditor have always checked the price of an inventory, either it is covered or bought the cost or not. Net realized value of the product either is bought or not, bought the cost or not. For the cost, you trace the supplier in the large. Yes, you have to trace the supplier's invoices in the large amount. You have to check the correct cost of the product. Inventory days is very simple. It means to say that you find out in the last year there are 20 days for the inventory, and this year this is the 50 days of inventory. Inventory days are 50, so it causes a worriness for an auditor. So it may be you have to check either the stock is correctly or there is a wrong stock is over there. That's why the inventory turnover ratio is slow as compared with the previous one. Or maybe their entity has a drive a long sales planning. NRV, net realizable value, at the year end again is calculated again at the time of the year end. I have to calculate the net residual value or realizable values for the product. Either these are sell accordingly or they are either these are below from the cost. Actual selling value is below from the cost or not. Look at the sale budget and talk to the sale director. At the end, you have to check the sale budget, how this budget come from and how this budget is prepared, what the arguments, what the evidences are over there. Okay, here we can see the chapter 21. It's a very easy bank and cash. Bank balance. Yes, bank balance, the amount of cash at the bank or bank overdraft is one of the most straightforward balances. This is straightforward balances in the statement of financial position to the audit. Auditor have a clear information from the third party to check. You may say the straightforward balance is over there because here is a third party involved who have a very care about your balances. Auditor write for the bank certificate and it shows all of the balances in the bank. Almost certainly, the auditor will write to the client's bank to obtain a bank report for audit purpose. Yes, bank statement, bank certificate, auditor get from the bank. The bank certificate will certify the amount of the various accounts of the client. Obviously, how much you paid, when will you paid, to whom you are paid, in which medium you paid. Everything is certified by the bank certificate. There may be a certain interest or bank charges over there as well mentioned in the bank certificate. Okay, the auditor will make sure the amount in the client cash book agrees with the amount in the statement of the financial position and will perform or reperform a bank reconciliation as evidence that the amount of cash is correct. Yes, very simple. The entity I'll always mention is the financial transaction in his cash book. Similarly, cash dealing is done by the medium of bank, and so there is another bank certificate report is over there. So, for an auditor, it's a very easy to cross check, reconcile the statement of the bank with the cash book of the entity. So somehow he may be reperform. So in this, he agree the balance of the bank statement to the bank certificate and agree uncleared deposits and unpresented checks. Everything is clear, every picture is clear in this statement. Confirm the balance for the bank statement adjusted for the reconcile item. As according to the journal ledger, balance of statement of the financial position. Every clean picture, you may say that there is clean picture of a cash deposit receiving and payments is over there, which may be confirmed from the book of account of the entity. So auditor easily can reperform or reconcile this one. Cash in hand is very simple. It's all about to the material amount of physical cash. In short, we take as a petty cash in our offices. So there is again check and there is a authorization is over there. For example, if the client runs a chain of shop each with a cash flow, then the least sum cash count will be carried out to confirm the existing accuracy of each balance at the reporting date. Yes, he have to sum at the end of the day and have to find how much cash in his hand. The auditor may routinely count cash because of the relatively high risk of, and auditor do this. I'll give an example. We internal auditor oftenly visit our cash counters and have to check randomly the cash balances over there. Either and he do because there is a risk of theft over there, so he do this a number of time within a day, or you may say after a week, to confirm that the how much balance and there are the true and fair operation is over there or not. So this is from today lecture. Thank you very much.